Will the stock market go back up? Is it going to recover and rebound and send us right back up to all-time highs? Or are we destined to retest the lows from February 24th and maybe even go lower than that? I'm going to get into all the scenarios that are affecting the stock market right now, what you need to know, and how you can plan accordingly. But first, make sure you pound that like button and subscribe to this channel so that you can get all of my notifications of any time I do a new video or a live stream. And click the join button down below so you can get all my stock market research delivered to you each and every day. Now, the last couple of days in the stock market has been really telling because up until today, we had seen consistent selling taking place in the broader market. And then we tried to go even lower today, but we saw a sharp rally on no news out of nowhere, just take the market right back up into positive territory. And you have the Fed now that's going very much like in a Volcker-esque like direction. Now, if you don't know who Paul Volcker was, he was the Fed chairman from 79 to 87 that sent us right into a recession in order to curb inflation. He did so by sending interest rates as high as 16.5% in the United States back in 1981. That's how bad it was. Now, I don't think we're actually going to have to get into double-digit interest rates, but I do think that we're going to have to get them a lot higher than what most people are comfortable with or what most people are even used to. For so long now, we've been sitting at 0% interest rates that the thought of even like a normal rate of 3% shakens people to their core. But the one thing that we're really not seeing so far is the stock market getting the picture. The bond market's getting it. The real estate market's starting to get the hint, but stocks, no. I mean, it could easily go back right to all-time highs next week. It is that close to making that kind of a move that it could happen any day now. And remember too, the higher the interest rates go, the less attractive stocks become because you can get a much safer return at a higher rate than what was previously had. And the Tina effect is really what's been propelling the stock market along with the Fed intervention for so long now because there's no other place to get a return. So now if there is another place to get a return because there's higher interest rates and there's safer returns, more and more investors, the higher and higher the interest rates go, will flock to the bond market. And next week, we're going to hear about what the CPI report is, the Consumer Production Index. If that comes above 8%, that's going to signal that inflation is not taming at all. And a more aggressive approach by the Fed is going to be necessary, maybe even an emergency rate cut, which frankly, for me, I'm shocked that we haven't even seen one of these yet because they needed to have done that 6 months ago. But with inflation, the costs of everything keeps going up. And when the costs go up, the spending power goes down for consumers. And if they can't buy new iPhones and if they can't buy the latest computer or splurge on that pool edition that they wanted to add to their house, guess what? Everybody's affected by it because if they're not buying, the businesses aren't profiting as much as they once were. And that's going to hurt those businesses come earnings time when they have to report and they're missing forecasts. I mean, you take mortgages, for instance, right? For so long, we've seen 2 and 3% 30-year mortgages. Now it's over 5%. That's over a 65% jump in interest that you'll be paying on a mortgage over the lifetime of that debt. But enough about what's going wrong in the country here. The stock market can oftentimes act differently than what the overall economy suggests it should be doing. And it's kind of like what we got going on right here since the rally that started off at the March 14th lows. Let's get to the charts and see exactly what I'm talking about here. So SPY, and this is a chart that goes about a little over a year back, okay? Head and shoulders pattern, massive head and shoulders pattern. But what's happened to it here of late? This is your head, this is your left shoulder, then you have your right shoulder. And then you have the neckline that goes right across here. It's a little bit messy, but it did confirm it at one point and even looked like it was going to push much lower. But instead, we had this little snapback rally followed by a quick sell-off and then this massive rally off of the March 14th lows that essentially nullified the whole pattern. But did it? So one of the things that I've been contemplating in recent days is, what if this wasn't just the right shoulder? This here wasn't the right shoulder, but this whole area was the right shoulder. It may be a stretch. I'm not willing to say, hey, that's definitely the entire right shoulder that's being formed here. But if we were to go back down to the lows, I think a lot of people would be claiming that. So it is something worth watching. Now, what makes it even more interesting is that from a bullish standpoint, yes, we broke that right shoulder of what we perceive to be the head and shoulders pattern from before. And now you have an inverse head and shoulders pattern forming. You don't believe me? Let's look at the chart here because it's crazy. So you have this neckline that's going right across here, and that's going to offer up some heavy resistance, this neckline right here. And then you have a left shoulder right there, and then a head, and then a right shoulder. But the right shoulder hasn't confirmed yet, and it hasn't really become well defined. This could easily just be a scenario where we don't ever form the right shoulder, and we just go straight back down to these lows from the February and March timeframe. But we got a little bit of a rally here today off of the 20-day moving average, recaptured the 200-day moving average, which, by the way, is not that big of a deal anymore. Moving averages are only important when price action makes them important. And what I mean by that is if you're seeing consistent action off a specific moving average for a particular stock or an index, that's important. But when you see it just violate a moving average and it just blows through it each and every time at will, then it becomes less relevant. And you can see here on multiple occasions, it has just gone above and below it without any problem at all. So I don't really care too much about the 200-day moving average at this moment in time. But I do consider this inverse head and shoulders pattern something to pay close attention to. Now, that's the bullish standpoint. What's the bearish argument that I'm looking at right here? Well, for one, you have a new declining trend line that is in place here. Again, price action is not that far away that it couldn't easily break back above it, especially if it confirms this inverse head and shoulders pattern that I was just mentioning, then it will be back above this declining trend line. But for right now, it's below it and it should be taken serious. You also have a lower channel band that could be forming here. And if this channel band continues to stick, it may indicate that we're in for a very long haul to the downside. It may not be a massive sell-off right out of the gates, but inside of this band, you could see some major moves, both higher and lower, suggesting that if we were to retest this lower channel band again in the future and hold it, there could be another rally just as significant as the one we just had off of the March 14th lows. Now on the weekly chart, and I want to take a look at that, you can also see the same downward channel starting to develop here, but we're still sitting right near the upper channel band. You haven't seen that huge push lower. Friday is going to be important as well as next week. But when you zoom in a little bit here, you have this red and this green moving average here, and they're getting very, very close to crossing each other. So there's a very good chance that in the next 2 to 3 weeks, you'll see a 20-50 week moving average crossover to the downside. Now, most of the time, I don't consider crossovers all that big of a deal because they lag price action so much. But when you have price action right here at the moving average as it's starting to cross over, that becomes a much more bigger deal. The Qs are even closer to realizing this with its 20 to 50 week moving average crossover happening anytime next week or the week thereafter. And it's acting as resistance as well. Both this red line and this green line acting as resistance for price. Now let's look at the SPY monthly chart. A lot of people say, Ryan, we've pulled back a ton so far. No, we haven't really. Let me show you the Fibonacci retracements because a lot of people swear by these things. And there's some truth to them. There's a lot of retracements at the 38, the 50, and the 62% retracement levels. I'm going to draw the Fibonacci retracements all the way from the lows of March 2020 to the January highs of this year, the all-time highs that were reached. So far, we've had a pullback to the 23.6% retracement level. Significant, but that's not necessarily a very steep retracement. Most of the time, you'll see a 38% retracement or a 50% retracement. And in the case of a very significant, severe correction, like what we saw in 2008, you could see one all the way back down to the 61 retracement level. Now, I'm not here going to call for that just yet, but a 38.2% retracement level would put us back down at the 38.2 level. And when I talk about a correction in the stock market that could last the better part of this year, it makes sense on the weekly chart when you're looking at this declining channel that it could take us well into October or November or December before we actually reach this 38.2% retracement level. I believe that the market is still tilting bearish. I could be wrong on that one, and I'm fine if I am. I'll flip to the long side if necessary. But for now, that's the way I tilt. One thing as traders that we have to remember, we can be wrong, and we're going to be wrong often. But what I like to do is I like to provide both sides of the argument in order to help you be able to make your own decisions so you can better understand the market and what we're facing as a whole. Like I said, I'm bearish. I have short positions in my portfolio. But if the market was to go back up to all-time highs next week, it wouldn't be the first time I was wrong, and that's okay too. So the takeaway in all of this, we've gone from don't fight the Fed to fight the Fed at every turn. From 2009 until 2022, it's always been buy the dip because we have quantitative easing on our side, Jerome Powell's on our side, Ben Bernanke's on our side, Janet Yellen's on our side. They're printing money all the time. Money printer go burr. Now we got the printer that's been broken down. We got a very hawkish Fed, and they're rising interest rates to an extent that no one really knows at this point. Because if inflation continues to crank higher, they're going to have to get more and more aggressive. If you enjoyed this video, I would encourage you to like, subscribe, and tell me down in the comments, what's your opinion and outlook of this market? Do you think we could go back to all-time highs next week? It's possible. Anything's possible in this market. So let me know in the comments down below. Thank you guys, and God bless.